everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 3 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled C equals current big or accelerated quarterly earnings and sales per share. You can read the original post at samfury.com.
All right, so today we're doing a deep dive into Chapter 3 of How to Make Money in Stocks, and we're focusing on bigger accelerating quarterly earnings and sales per share.
Yeah.
Now, you're probably already familiar with the basics, but trust me, we're going way beyond the surface here.
Absolutely.
We're going to be uncovering the subtle art of reading between the lines of those earnings reports to find those companies that are truly poised for breakout growth. It's not just about the numbers themselves. It's about what they tell us about a company's story.
Yeah, and it's fascinating how throughout stock market history, the biggest winners,
Right.
the ones that really skyrocket in value, almost always have this one thing in common.
What's that?
It's a track record of strong and accelerating earnings.
Okay.
Think of it this way.
Yeah.
Earnings are the fuel that propels a company's growth and ultimately its stock price.
Yeah, that makes sense.
Yeah.
But O'Neill gets super specific about what to look for. He recommends at least a 20% jump in the most recent quarterly earnings per share, or EPS,
Right.
compared to the same quarter the year before.
Yeah.
So why that specific comparison? Why not just look at quarter-over-quarter growth? It seems like that'd be more up to date.
That's a great question, and it gets to the heart of why this approach is so powerful.
Okay.
See, comparing earnings to the previous quarter can be really misleading because of seasonal variations that so many businesses experience.
Yeah.
Imagine a company that sells winter coats, right?
Yeah.
Their sales might peak in December and then would drop off significantly in the spring.
Right.
So by comparing earnings year over year, we can filter out those seasonal fluctuations and get a much more accurate picture of the company's true growth trajectory.
So it's comparing apples to apples.
Exactly.
You're making sure we're not comparing a company's peak season to its slow season.
Exactly. We're looking for that consistent, sustainable growth, not just a temporary bump. Now, let's talk about EPS itself.
Okay.
It's the most critical factor to consider when we're evaluating a company's earnings.
Okay.
It's essentially a measure of profitability on a per-share basis.
Got it.
You calculate it by dividing the company's after-tax profits by the number of common shares outstanding.
Okay, so if a company earns like $100 million and there are 10 million shares outstanding, the EPS would be $10 per share.
Exactly.
Okay, simple enough. But what does a good EPS look like? Is it as simple as the higher the better?
Well, while it's true that higher EPS percentages generally indicate stronger profitability, it's important to remember that EPS is only one piece of the puzzle.
Okay.
We need to consider it within the context of other factors, like
Yeah.
sales growth, profit margins, industry comparisons.
Sure.
And we also need to be mindful of potential red flags like earnings manipulation or unsustainable growth.
Let's talk about those earnings reports themselves.
Yeah.
I know they can sometimes be a bit, well, let's just say companies have a knack for putting a positive spin on things.
Companies naturally want to present their performance in the best possible light.
Of course.
And sometimes that can lead to earnings reports that are a bit, shall we say, polished.
Right.
It's our job as investors to look beyond the surface and really understand what's going on behind those numbers.
So what are some tips for seeing through the hype and getting to the heart of those earnings reports? What should we be focusing on?
Well, here's where it gets really interesting. Don't be fooled by flashy headlines about overall sales or net income.
Okay.
What we really care about is that EPS percentage change compared to the same quarter the previous year.
Got it.
That's the true measure of growth.
Okay.
And be wary of those one-time gains that can inflate earnings. For example, if a company sells off a piece of real estate and books a huge profit,
Right.
that might look impressive on paper,
Yeah.
but it doesn't really reflect their core business operations.
So we're looking for consistent organic growth in EPS,
Yeah.
not just temporary boosts. And we need to be critical thinkers, not just taking those earnings reports at face value. It's
Right.
like being a detective, right?
Exactly.
Piecing together the clues to understand the real story.
Precisely. And that detective work involves looking ahead as well.
Okay.
Past performance can give us valuable insights into future potential.
Okay. I'm intrigued. How do we use past performance to project future earnings? It sounds like we're trying to predict the future.
Well, it's not about predicting the future with certainty,
Okay.
but rather about identifying patterns and trends.
Okay.
Start by comparing the upcoming quarter's earnings to the same quarters in the previous year. Are there any recurring themes?
Right.
Any potential trends emerging? You're looking for those breadcrumbs, those hints that can help you piece together a narrative.
I like that analogy. We're not fortune tellers.
Right.
But we can be shrewd observers, right? Looking for clues that might indicate where a company's headed.
Exactly. And don't forget about those consensus earnings estimates from analysts.
Okay.
They're basically combining their collective wisdom and research to provide a forecast of a company's future performance.
Got it.
While not always perfect, they can provide valuable insights.
So we're essentially gathering evidence from the past, combining it with expert opinions about the future, and forming our own conclusions.
Right.
It's like putting together a puzzle piece by piece.
That's a great way to put it.
Yeah.
And remember, one of the key things we're looking for is evidence of a growth-oriented mindset.
Okay.
O'Neill argues that a lot of established companies, they kind of become complacent.
Right.
They prioritize maintaining the status quo over pursuing aggressive growth.
Yeah, I can see how that would make a big difference. If a company is content with their current position, it's unlikely to see those explosive earnings increases that we're looking for, right?
Exactly.
Yeah.
We want to invest in companies with leadership that's hungry for growth, constantly seeking new opportunities, pushing the boundaries of innovation.
Right.
That's where the real potential lies.
So besides EPS, what other clues can tip us off to a company's growth potential? What else should we be looking for in those earnings reports?
Well, one key indicator is how often analysts are revising their earnings estimates upward. If they're consistently raising their projections, that suggests growing confidence in the company's future prospects.
Okay.
And pay close attention to the extent to which companies are exceeding those expectations when they release their earnings reports. The bigger the beat, the better.
So we're looking for positive surprises.
Exactly.
Companies that are exceeding expectations and delivering on their promises. It's like they're hitting it out of the park.
Yes.
Exceeding even the most optimistic forecasts.
Precisely. And it's not just about earnings in isolation.
Okay.
O'Neill emphasizes the importance of looking at sales growth as well.
Got it.
Ideally, you want to see at least 25% sales growth alongside those strong earnings.
I'm curious, why is it so crucial to see growth in both sales and earnings? Can a company have one without the other?
Well, while it's possible for a company to experience short-term fluctuations in either sales or earnings,
Right.
consistent growth in both over several quarters is a really powerful indicator of a healthy and sustainable business.
Okay.
Think of it this way. Sales growth tells you that a company is attracting more customers and generating more revenue. But earnings growth tells you that they're doing it efficiently,
Right.
that they're managing their costs and maximizing their profits.
So it's like a dynamic duo.
Exactly.
We're looking for companies that are firing on all cylinders,
Right.
both bringing in more revenue and converting it into profits. It's about finding those companies that are not just growing, but doing so in a sustainable and profitable way.
Absolutely. Consistency is key.
Yeah.
It shows that a company's success isn't just a fluke.
Right.
It's a trend that's likely to continue.
This is all starting to make a lot of sense. We're not just looking for any company with high earnings.
Right.
We're searching for those with consistent, accelerating growth in both sales and earnings. Those that are exceeding expectations and exceeding their past performance. It's about identifying those companies that are on a trajectory for long-term success.
That's a great way to summarize it.
Yeah.
And remember, another key factor to consider is profit margins.
Okay.
This tells you how much profit a company makes for every dollar of revenue.
Got it.
We want to focus on companies with high after-tax profit margins that are either at or near record highs
Okay.
and are leaders in their industry.
So it's not just about making a profit.
Right.
It's about making a healthy profit.
Exactly.
We want to see those companies that are truly excelling, those that are at the top of their game and that are outperforming their competitors.
Exactly. And to really assess a company's performance, it's helpful to compare it to its peers in the same industry.
Okay.
If you find one impressive stock in a particular industry, chances are there's another one out there as well.
It's like a treasure hunt.
Exactly.
Once you find one hidden gem, there are more to be discovered.
Exactly. It's about finding those companies that are doing something special,
Right.
that are standing out from the crowd. And sometimes those standouts are clustered together within specific industries.
This is all incredibly insightful. I'm learning so much. But I have to ask, even the most successful companies can stumble, right?
Of course.
What should we be on the lookout for in terms of warning signs? When is it time to hit the brakes?
That's a crucial question, and one that every investor needs to be prepared to answer.
Right.
Even the most promising companies can experience setbacks.
Sure.
And it's important to be able to recognize the difference between a temporary blip and a sign of more serious problems.
Right.
One of the biggest red flags is a significant decline in earnings growth over 2 consecutive quarters.
So we're talking about a sudden loss of momentum.
Right.
A shift from acceleration to deceleration. It's like a car hitting the brakes after cruising at high speed.
Precisely. If a company goes from posting strong double-digit earnings growth to barely breaking even or even experiencing a decline, that's a signal that something might be wrong.
Okay.
It's time to dig deeper and understand why this is happening.
So we need to be vigilant, watching for those signs of slowing growth, and then investigating further to determine if it's a cause for concern.
Exactly.
It's about staying informed and being proactive.
Exactly. And sometimes those warning signs can actually present opportunities.
Oh, really?
If a company is experiencing temporary difficulties, but has a strong underlying business and a solid plan for turning things around, their stock might be undervalued. It's all about assessing the situation carefully and making informed decisions.
So it's not always about running away from those red flags.
Right.
Sometimes it's about understanding the context and seeing those challenges as potential buying opportunities.
Exactly.
It's like those contrarian investors who go against the crowd and find value where others see risk.
That's a great way to put it. But of course, it's crucial to proceed with caution and do your due diligence before making any investment decisions.
Right.
Don't just blindly jump into a stock because it seems undervalued.
Sure.
Take the time to understand the situation fully.
Now, before we move on, I want to revisit something you mentioned earlier. Visualizing earnings trends on a logarithmic chart.
Yeah.
Why is this so helpful?
Yeah.
It sounds a bit technical.
You're right. It is a bit technical, but it's worth understanding
Okay.
because it can be a powerful tool.
Okay.
A logarithmic chart, unlike a standard linear chart, allows you to see those changes in earnings growth more dramatically. It compresses the scale, so even small changes in growth rates become more visually apparent.
Gotcha.
It's a fantastic way to spot those trends of acceleration or deceleration.
So it's zooming in on those crucial shifts in earnings growth?
Exactly.
Seeing them with more clarity? It's like having a magnifying glass for earnings trends.
Exactly.
I
It can help
see.
you identify those inflection points. Those moments when a company's growth story is shifting gears, either for better or for worse.
I'm starting to see how all of these pieces fit together. We're looking for companies with strong, consistent earnings growth. But we also need to be aware of those potential warning signs.
Yeah.
Those shifts in momentum that might indicate it's time to reassess our investment.
Absolutely.
And visualizing those trends on a logarithmic chart can help us spot those changes more easily.
Exactly. And remember, even with all these tools and insights, investing always carries some level of risk.
Right.
The market is constantly evolving, and unexpected events can happen.
Of course.
But by developing a deep understanding of a company's earnings story, you can make more informed and confident investment decisions. And that's what it's all about.
Absolutely. It's about empowering ourselves with knowledge and using it to navigate the complexities of the stock market. Now, you mentioned some great resources earlier for actually finding these earnings reports.
Sure.
Could you remind us what those were?
Of course, O'Neill recommends Investors Business Daily, IBD,
Okay.
Daily Graphs, and Daily Graphs Online.
Got it.
These resources provide comprehensive earnings data charts and analysis that can be incredibly valuable for investors.
Fantastic. Those are some great starting points for anyone who wants to dive deeper into the world of earnings analysis. All right. You mentioned earlier that it's not enough to just look at the numbers.
Right.
We need to understand the story behind those numbers. Can you elaborate on that a little bit? Like, what kind of questions should we be asking ourselves when we're analyzing these earnings reports?
Well, one of the most important questions is, what's driving the company's success?
Okay.
Are they launching innovative new products
Right.
that are capturing market share? Are they expanding into new markets, tapping into new customer bases? Or are they simply becoming more efficient, streamlining their operations and boosting their profit margins?
So we're looking for those catalysts for growth,
Right?
those factors that are giving the company a competitive edge and propelling their earnings upward.
Exactly.
It's not just about seeing high earnings. It's
Right.
about understanding why those earnings are high.
Precisely. And we also need to look ahead, not just at the present.
Duh.
Ask yourself, what are the company's future prospects? Do they have a strong pipeline of new products or services in development?
Right.
Are they well positioned to capitalize on emerging trends in their industry?
Mm-hmm.
Are they adapting to changing consumer preferences?
I see. So we want to invest in companies that have a clear vision for the future, companies that aren't just riding the current wave, but are anticipating the next one.
Right.
It's about finding those companies that are forward-thinking and adaptable.
That's a great way to put it. And remember, investing is all about managing risk.
Right.
By understanding the story behind a company's earnings, we can make more informed decisions about whether or not their stock is a worthwhile investment. We can assess their ability to navigate future challenges and capitalize on emerging opportunities.
So how do we go about comparing companies within an industry? What are some of the key metrics that we should be looking at beyond just EPS?
Well, EPS is certainly a fundamental metric,
Right.
but we also want to look at things like profit margins, return on equity, and debt-to-equity ratios.
Okay.
These metrics can give us a deeper understanding of a company's financial health and its ability to generate profits.
So it's like we're doing a financial checkup,
Right.
making sure the company is in good shape and has a strong foundation for future growth.
We're looking for companies that are financially sound,
Right.
that are managing their resources effectively, and that are generating strong returns for their investors.
I'm starting to get a much clearer picture of how to evaluate a company's earnings, but I have to admit, I'm still a bit intimidated by the sheer volume of information out there.
Yeah.
Where do we even begin?
I understand. It can feel overwhelming at first. But the key is to start small.
Okay.
Focus on a few companies or industries that genuinely interest you and gradually expand your knowledge from there. Don't try to learn everything at once.
That's reassuring. It's like learning a new language.
Exactly.
You don't try to memorize the entire dictionary overnight.
Right.
You start with the basics and gradually build your vocabulary over time.
Exactly. And remember, there are plenty of resources available to help you along the way.
Right.
There are books, websites, podcasts like this one, and even financial advisors.
Sure.
All dedicated to helping investors of all levels understand the stock market. So don't be afraid to seek out help and guidance.
This has been an incredible deep dive into the world of earnings.
Yeah, it has.
I've learned so much, and I'm confident that our listeners have too.
Me too. And to our listeners, remember to stay curious, keep learning, and never stop exploring the fascinating world of investing.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.